clearly there is rivalry between America and China. That is causing trade wars and what we call capital wars at the same time. But you're seeing a reformulation of the monetary systems in both economies, where China is simultaneously buying gold or accumulating gold, but it's also buying in gold. So what you've got is a Chinese monetary system that is absolutely not returning to a gold standard, but it's moving towards a gold-backed system. So what you're seeing in the background is, as China prints money, it is buying more and more gold on the open markets. It's trying to hide those purchases. America is simultaneously acting to underpin its monetary system, but it seems to be doing that through the vehicle of stablecoins. And stablecoins are a brilliant innovation because what they do is they threaten other international monetary systems, but more particularly, they may well lead to a re-dollarization of the world.
Recent forecasts point to continued strength in the gold and silver markets, driven by resilient investor demand and unprecedented central bank buying. For 2026, Deutsche Bank has raised its gold price forecast to an average of $4,450 per ounce, citing inelastic demand from central banks and ETF inflows diverting supply from the jewelry market. Goldman Sachs similarly projects gold could reach $4,900 per ounce by the end of 2026, highlighting continued central bank accumulation, especially by China, increased private investor inflows, and rising geopolitical risks. This institutional accumulation represents a structural shift, as many central banks are now using monetary expansion programs to finance gold purchases, viewing it as a strategic asset to diversify reserves and counter currency concentration risks. The video features Michael Howell, the CEO of CrossBorder Capital, an independent research and investment company and author of Capital Wars. Howell discusses the growing rivalry between the US and China, which is causing a divergence in global monetary systems. He notes that China is accumulating gold to provide a bulwark for a gold-backed monetary system, not a return to a full gold standard. Simultaneously, America is underpinning its system with stablecoins, digital collateral backed by US Treasuries, which could lead to a re-dollarization of the world by threatening other international monetary systems. This ultimately sets up two competing global financial models: China's gold-backed yuan versus the US dollar backed by digital collateral. Let's watch clips from Michael Howell's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
So if you could talk about some of the drivers that you believe are driving gold now, so would it be still the big players, the central banks, or is it more moving towards that retail side now that's driving the price?
So if you look at the global liquidity cycle, by definition, as I said, a cycle goes up and it comes down. And as it moves through the phases, asset allocation changes. And the way that we think about this is basically to say that if you look at the cycle schematically, what it's illustrating on the left-hand side is that the liquidity cycle, which is when everything emanates, in our view, from liquidity, has four very distinct phases, which we call here calm, speculation, turbulence, and rebound. So there's four quadrants, if you like, of that asset allocation cycle, that liquidity cycle. Then if you look at the asset allocation cycle, there are also four quadrants that we identified. They're slightly askew from where the liquidity cycle is. In other words, they overlap. But generally, in the upswing, you find equities perform strongly. Around the peaks of the cycle, commodities do well. As you go down the cycle, in other words, in this risk-off phase, you want more cash. And as you hit the bottom of the cycle, towards the bottom, we're in the turbulence phase of the liquidity cycle, you want longer duration government bonds. And then the cycle restarts. Now, you can see that in terms of this traffic light system, which is basically saying this is how we tend to undertake our asset allocation and how we advise investors. And what we look at is, first of all, asset classes on the left-hand side, and then industry group areas on the right. Now, the asset classes that you can see depicted there are equities, credits, commodities, and government bonds. Bond duration is just saying, do you want to own longer duration government debt. And what this is broadly saying is that in the rebound phase, the early cycle phase, you want equities and credits, you don't want commodities, and you don't want bond duration. As you move to calm, you equally don't want bond duration. You can start to move more into commodities. You start to pare back your exposure to credits, and you maintain equity exposure. And if you think about these as traffic lights, I mean, what they're really saying is green is go, red is stop, and amber is proceed with caution. So that's how we would tend to read them as well in terms of asset allocation. Once you get to the speculation stage, you want to proceed with caution in equities, and that's where we are, we believe right now. Certainly for Wall Street, we're in that phase. Commodities is still go green for go. Credits, you probably want to start paring back because the liquidity cycle is rolling, in our view. And bond duration is probably a bit too early, but you can start to accumulate some bonds. So that's how that cycle works. And as I say, we're broadly in that commodity phase around the top of the cycle right now. So that's one of the reasons that gold is being favored. Now, there's another reason why gold is being favored, which I'm going to move on to, which is further in this presentation. And that's looking at what China is doing in terms of its debt. This chart is showing the ratios in the Japanese economy and in the Chinese economy between debt and liquidity. So if you have a very high debt liquidity ratio, what that's really saying out loud is that you've got debt refinancing problems. And if you've got debt refinancing problems, financial markets often derail or at least significantly underperform. And that's really been Japan's history, really since the 1990s. So you can see the debt liquidity ratio in Japan has gone sky high as debt has accumulated and liquidity has been tightened. So that ratio has gone awry. The Japanese have got out of that problem in the last 10 years or so through what's been called a policy of Abenomics after the late Prime Minister. And on top of that, they've had the Bank of Japan buying government debt very aggressively. And what that has meant is the debt liquidity ratio has come down. The yen has weakened substantially, as you'll recall, and Japan is basically trying to get back to a much more stable economic equilibrium. Now, China is in a very similar situation. And if you look at the orange line, that's the Chinese debt to liquidity ratio, and it looks remarkably similar to what transpired in Japan about 10 or 15 years earlier. So China has a big debt problem. We know that. We know that debt problem is saddling the economy and the financial markets with problems. And China is trying to dig itself out, and it's following exactly the same playbook that Japan is following. And what they're going to have to do is to add liquidity. In other words, they'll have to monetize their debt. Now, therein lies an interesting puzzle because China is an export economy and it's very conscious about the level of the yuan exchange rate, particularly against the US dollar. And that's become really a geopolitical axis that is very difficult to change. So what China is doing, in our view, is that it's devaluing its paper money against gold. And one of the ways it's doing that is to print money quite aggressively. And if you look at this chart, which is looking at PBOC, People's Bank of China liquidity injections, this is showing the number of billions of renminbi or yuan that they're injecting into the system over a 6-month window. And you can see what happened in early 2025, where there was a significant jump in those liquidity injections. Now, that is China printing money, and China, as it inflates its economy, what you see is asset markets go up. So certainly you've seen the Shanghai stock market propelled higher. You've had the yuan gold price devaluing significantly, in other words, rising significantly in yuan terms. And there are some signs, although tentative signs, that maybe property prices are starting to stabilize now. But if you look at this chart, this is looking at the yuan gold price. And the yuan gold price has been catapulted higher by this monetary stimulus. And the real question is, or the real two questions are, number one, is China targeting the gold price? rather than, let's say, the yuan US dollar cross. And I think it is. I think this is a deliberate policy that they're trying to get the yuan gold price up, because if they do that, they're devaluing paper money against real assets, and that's the problem that is really hurting the Chinese economy right now. The second question is does China control the gold price globally? And I think there is increasing evidence that maybe it does. It certainly controls the physical market. Whether it has, a bigger sway over COMEX or the London Exchange is really a moot point. But the Shanghai Gold Exchange is clearly very important. Now, why is this such an important issue? And it's an important issue because what you're seeing out there is a sort of divide in the international monetary system, or a divergence, if you like, between two currency models. Clearly, there is rivalry between America and China, and that is, causing trade wars and what we call capital wars at the same time. But you're seeing a reformulation of the monetary systems in both economies, where China is simultaneously buying gold or accumulating gold. It's the world's biggest producer, as you know, but it's also buying in gold. And so what's happening is they're giving further stability, or a bulwark, to their monetary system with this gold backing. So what you've got is a Chinese monetary system that is absolutely not returning to a gold standard, but it's moving towards a gold backed system. And that is an important observation. They will still have fiat money, that's important to them, but there is an element of stability provided by this gold stash. And that, I think, is what China is doing. So what you're seeing in the background is, as China prints money, it is buying more and more gold on the open markets. It's trying to hide those purchases, but many independent observers have very astutely noted that China is surreptitiously buying whatever gold is available in the open market. So that's point number one. Point number two is that America is simultaneously acting to underpin its monetary system, but it seems to be doing that through the vehicle of stablecoins. And stablecoins are a brilliant innovation, because what they do is they threaten other international monetary systems, but more particularly, they may well lead to a re-dollarization of the world. And a stablecoin, which is basically a notional digital wrapper put around treasuries, is something which is being made available to depositors worldwide. So if you're in, let's say, a questionable monetary jurisdiction where you're not confident about your domestic currency, why don't you just buy a dollar stablecoin? But that could extend, not just to the likes of Turkey or Brazil or Argentina or wherever. That could equally extend to the Eurozone, and it could extend to China. And those monetary systems, I think, are running scared of the prospects of what this could mean. Now, the end game, and I'll stop after making this comment, but the end game is that you've got a world financial system that is moving in two directions. One is towards a Chinese gold-backed system for the yuan, and one which is a US dollar backed by digital collateral, in other words, by stablecoin in some form. And America is more or less saying, well, look, if you want to trust our dollars, you've got to trust our technology. And China is more or less saying, if you want to trust the yuan, you've got to trust our gold backing. And it's very much in America's interest looking forward to destabilize the gold market. And it's very much in China's interest looking forward to destabilize the crypto or the digital asset market. And that may be by cyber attacks being launched by, quantum computing or whatever. So that's the way the world is going.
Michael Howell concludes that the global financial system is dividing into two distinct models. China is purposefully devaluing its paper money against gold, accumulating the metal to provide a stable, gold-backed system for the yuan, thereby addressing its domestic debt issues. Conversely, the US is fortifying the dollar's global position using stablecoins, which are digital wrappers backed by US Treasuries and are being made available globally. The resulting financial rivalry sees America aiming to destabilize the gold market, while China's interest lies in destabilizing the digital asset or crypto market. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.